Welcome to Breaking News to Trading Moves. Today we're looking at the market moves following some fresh M&A talk around Papa John's.
That's right. It seems pretty concrete this time, well, based on reports anyway. Apollo Global is apparently back with a new offer.
Okay, what are the specifics?
The word is it's an all-cash offer, $64 per share to take Papa John's private. That's ticker PZZA.
PZZA, got it. And the stock, PZZA, reacted as you'd expect.
Oh yeah, it spiked pretty much immediately on the news. But, we have to say, nothing's signed yet. It's not a done deal.
Right, crucial point. Still just reports at this stage.
But even the talk itself is important. That $64 figure, all cash. It kind of lists the perceived value, doesn't it? Not just for pizza places, but maybe for the wider fast casual restaurant space.
So it suggests maybe there's more life in the deal pipeline? For private equity, for the banks?
Exactly. It could signal things are maybe thawing out a bit in terms of big transactions.
Okay, that sets things up nicely. As always with news like this, there are potential winners and, well, potential losers. Let's start with the winners. Who benefits here?
Well, the most obvious place to start is companies that might get revalued based on this.
PZZA itself, obviously, if the deal happens at that price.
Right. But beyond them, think about the competitors. That $64 price tag, it sets a higher bar, a sort of new takeout multiple for the whole pizza sector.
How does that work exactly? Just because Apollo might pay that for PZZA.
Yeah, it's what the market sometimes calls a sympathy re-rating. If a big, savvy buyer like Apollo thinks PZZA is worth, say, X times its earnings, then the market looks at similar companies and thinks, hang on, maybe they're undervalued too, if that's the going rate.
Ah, okay, so that explains why you might see a name like Domino's Pizza moving. That's DPZ, right?
Exactly, DPZ. They might see a bump, not because their pizza suddenly got better overnight,
Right.
but because this PZZA news potentially raises the ceiling on what someone might pay for any big pizza chain. It suggests maybe the current public market price for DPZ doesn't fully reflect its potential value in a takeover scenario.
Got it. So PZZA and DPZ are in that first bucket. What's the next group of winners?
Well, you mentioned the deal pipeline, folks. The sponsors themselves, the private equity firms, and the banks involved in these kinds of deals.
Okay, why them?
It's really about confidence and maybe a sign of life for leveraged buyouts, LBOs. We know high interest rates really put a damper on LBOs for a while.
Because the debt needed to do the deals got too expensive.
Precisely. LBOs run on debt. So a big bid like this suggests that maybe, just maybe, the financing is becoming available again, or at least workable, at terms that make these deals possible.
So the market reads it as a positive signal for big M&A.
Yeah, potentially. So Apollo Global, that's ticker APO, they're the bidder here. They clearly look like winners if they can pull this off. Shows they have access to capital and a plan.
And does that positive feeling extend to their peers?
You could argue it does. A firm like Blackstone, ticker BX, they have a lot of restaurant and consumer investments. News like this, suggesting big deals can get done, probably helps the sentiment around them too. It implies a healthier environment for them to potentially sell assets or put money to work.
Okay, so the pizza players and the deal makers, who else?
There's a more subtle one, maybe.
Yeah.
The delivery partners.
Oh, like DoorDash and Uber Eats. Why would they benefit from a Papa John's buyout?
It comes down to the typical private equity playbook after an LBO.
Right. What's that involve?
Well, PE owners usually have a fairly short time horizon, maybe 3 to 5 years. Their goal is often to boost key metrics like same-store sales, customer loyalty, pretty quickly before they look to sell the company again or take it public.
They need to show fast improvement.
Exactly. And one common way to do that is to really ramp up spending on promotions, discounts, marketing, partnerships. Basically, spend money to grab market share and drive traffic.
Ah, I see. So if PZZA goes private, the expectation is they'll likely spend more aggressively on promotions.
That's often the case. And where does a lot of that promo spending and partnership money flow?
To the delivery platforms.
Right. So companies like DoorDash, ticker DAASH, and Uber, ticker UBER, through Uber Eats, they could see a direct benefit. More orders potentially, maybe higher ad spending from a newly private, aggressive PZE flowing through their systems.
So a temporary boost for them while the new owners try to juice the numbers.
That's the read-through, yeah. It's often part of the strategy to make the business look as good as possible for the eventual exit.
Okay, that covers the winners pretty well. Let's flip it now. Who
Right.
might be on the losing end or face some pressure from this?
Well, the most direct pressure is probably on the competitors, especially if this deal goes through and PZZA gets recapitalized as a private company.
But wait, you said Domino's, DPZ, was a winner because of the valuation re-rating? How can they also be a loser?
Yeah, that's the interesting part, isn't it? It's two sides of the same coin. DPZ, the stock, might benefit from the higher potential takeout value for the sector. But DPZ, the business, now faces a potentially tougher competitor on the ground. Imagine a private PZZA backed by Apollo's resources,
Mm.
and crucially, freed from worrying about quarterly earnings reports and pleasing public shareholders every 3 months.
They can afford to be more aggressive, maybe take short-term margin hits for long-term gain.
Exactly. They might decide to spend heavily on price discounts, maybe roll out new products faster, flood the airwaves with advertising,
Mm.
all things that put pressure on incumbent sales and profit margins.
So who feels that heat most directly?
Well, you'd look straight at Yum Brands, ticker YUM, because of Pizza Hut.
Mm.
But yes, DPZ faces it too. Their stock might be up on valuation hopes, but their stores are still competing directly with PZZA stores, which might suddenly start offering, endless two-for-one deals.
Right, a challenge for their operations teams. Okay, what about companies outside of the pizza world? Any potential downsides there?
There's a potential, maybe temporary issue we sometimes call M&A crowd out.
Crowd out, what's that?
It just means when a really big deal like this PZZA1 is actively being worked on, it ties up a lot of resources. Think about the private equity teams doing due diligence, the bankers trying to arrange potentially billions in financing.
Right, it takes focus and capital.
Exactly. So if you're another company, maybe a different type of restaurant chain, that was hoping to get bought or find a private equity partner soon, you might find that the potential buyers or the lenders are suddenly very busy. Or maybe they've allocated a lot of their available capital or risk budget to this big PZZA deal.
So other potential deals get put on the back burner for a bit.
It can happen. It's a
Yeah.
capacity thing. So maybe companies like, say, Wendy's, ticker to WEN, or Shake Shack, SHAK, if they were hypothetically in any kind of discussion, might find things slow down while everyone's attention is on PZZA. The system only has so much bandwidth for mega deals at once.
Okay, that makes sense.
So-
Kind of bottleneck effect. Any other groups potentially feeling some pressure?
Yeah, one more, and this is another fairly standard LBO playbook consequence.
Yeah.
The food distributors.
The companies that supply the ingredients to the restaurants.
Exactly. Think about Cisco or U.S. Foods. A really common step after an LBO, almost mandatory really, is a big push for cost takeout.
Why is that so crucial after an LBO?
Because the new private owner, like Apollo in this case, has usually borrowed a lot of money to buy the company. They have massive debt payments to make, starting almost immediately.
So they need to find savings fast to help cover those payments.
Precisely. And the quickest way to boost profits, or EBITDA, isn't always selling more pizzas right away. It's often squeezing costs out of the existing operation. And a big chunk of costs is what you pay your suppliers.
So they go back to their distributors and demand better pricing.
Pretty much. They'll often pressure suppliers for lower prices, maybe demand longer payment terms, basically try to renegotiate contracts from a position of strength, sometimes using the promise of future business volume as leverage.
So the big distributors like Cisco, ticker SYY, and US Foods, USFD, could face margin pressure if PZZA goes private and implements this kind of cost-cutting.
That's the typical expectation, yes. Distributors often operate on relatively thin margins anyway, so a major customer demanding concessions can definitely impact their profitability. They're essentially being asked to help fund the LBO indirectly through lower prices.
Okay, that covers the main potential winners and losers across the board. But let's circle back to where we started. This deal isn't actually done yet.
Absolutely vital to remember. All this analysis is based on reports and the potential transaction. The trading updates we're seeing emphasize, the deal isn't finalized. The companies involved aren't commenting publicly.
And there are risks involved in getting it over the line.
For sure. Sources mention there are still many moving parts. Even if the $64 price is agreed upon, securing the financing is key. Apollo needs to raise a lot of debt capital, and while the debt markets might be better than they were, it's never guaranteed, especially the cost of that debt. That financing risk is a big factor.
Right, so lots still has to happen. But just thinking about the implications, that $64 per share figure, even as just talk, sets a marker, doesn't it? It does. You have to wonder how many other boards at publicly traded fast casual companies, chicken places, burger joints, Mexican chains are now looking at that number and maybe thinking again about what their company might be worth in the private market.
It definitely changes the conversation. Okay, that's a good place to leave it. Just a final reminder for everyone listening. Please remember, the content of this discussion is not financial advice or a recommendation to buy or sell any security. This analysis is purely the opinion of the author.